Today's guest is Moncef Heddad, a global investor and entrepreneur whose journey spans JP Morgan, Lehman Brothers, Barclays, and nearly 2 decades across the US, Asia, and now the Middle East, where he works closely with family offices, startups, and private investors across the region. In this conversation, Moncef opens up about how living outside of his comfort zone has shaped his worldview, why purpose beats titles, and the harsh truths every founder needs to hear, especially when it comes to fundraising, choosing the right investors, and knowing when to walk away. I wanted to talk about your journey and your global perspective and how that has shaped you into who you are today. So maybe let's start off from your professional experience. You've obviously worked across some of the world's biggest and most notable financial institutions, from JP Morgan to Lehman, all across the world, and from VC to private equity roles. So I wanted to ask you, what's the common thread that you've seen across geographies and across different banks and different industries?
Well, thank you for having me here, Harold, first. So from background, I was born in Morocco. I grew up in the States, did my education in the States. I started my career with Barclays, and then worked for other bulge bracket firms in the US. And then end of 2003, I moved to Asia, to Hong Kong, where basically I lived about 20 years. And for 1 year, when I was working for Lehman Brothers, I was spending more time in Japan than actually in Hong Kong. So I'd say it was a very unplanned journey that I had. Never thought I'd be living in places that I lived. I never thought I'd be doing what I've done. And all I can say is it's been very fulfilling, and it's been very humbling, really, at the end of the day. And that's, if you ask me about what shapes, is traveling, living in places where you don't speak a language, where you don't eat the food, where, well, afterwards I ate everything, but it's very good to put yourself in an environment where you are very uncomfortable, because that's where you test your limits, and usually it gets the best out of you coming out. So going to places that are familiar to you will never help you with personal growth. So personal growth has always been my objective from everything I do.
Wow, really impressive. And obviously it's very safe to say that you've climbed the corporate ladder, you've succeeded in the corporate ladder, and now you're transitioning to a more entrepreneurial career. Would you say that's correct?
It's part of it. I think I always had this entrepreneurial little boy inside me all the time. Even when I worked I think it started when I first started working at Lehman, at JP Morgan. I think I always wanted to have my own business. I was trying to do things on the side. I think I would say I was never satisfied with whatever I had in the past. But also think that the combination of all these things that I've done in the past, and a lot of more failures, I'd say have shaped me where today I know what I want to do. I always lived with a purpose, but I would never live satisfied. So I think today, given everything that I've been through, and I always had this question of why these things are happening, always ask a lot of questions. But today I know exactly what I'm here for, and I think knowing what you're here for in this world is very important.
So if you don't mind me asking, I'm sure it's very interesting. What would you say you're here for, and what's your true purpose, and how has all these experiences, corporate and entrepreneurial experiences, shaped that outcome or that answer?
Well, that's a very good question, and it has a few elements.
We're here to listen.
Yeah, I would consider myself, I'm probably more spiritual than religious. Obviously, there is the Islamic background that I have. But I did, throughout the life, I understood that being religious is not enough, right? I think spirituality is very important, and being open-minded. So what is my purpose in this world is to serve.
To serve.
Yeah, and to serve whom is to serve Him. Call it the Almighty, call it Allah, call it the Supreme Being, call it the grand architect of this universe, you can call it whatever you want, but there is a supreme being who I'm serving. How you're serving is in life, you're always gonna meet people in your life. There are people gonna be giving you good experiences and people that are gonna give you bad experiences, but they're equally important. What I mean by is the Almighty sends you people in your life, in your journey, and some of them will break you to pieces. People are always gonna say, you can't trust people, you can't do this. I think at the end of the day, everything that gets sent to you is for a purpose. And at the end of the day, personally, I know I'm here to serve, and I'm here to help. And my promise to him is if I continue doing this, he's gonna keep helping me. So I don't live for myself, I live for what I can do in general. And it's not about doing to a person, but it's more of a lifestyle what you do. So when we live in this life, we have probably 40 years of premium time, and then we have another 20, 25 years of non-premium time, which you're gonna spend potentially with your grandchildren and so on.
As a follow-up, I would say then, both through what you just described and also your professional experience in investments and private equity or things that have very long cycles, would you say that perhaps one of the most important virtues is patience? And would you give that as a important form of advice to founders, to investors, and to people around you?
I'd say patience and faith. You need to have some type of faith and you need these two things to go hand in hand. This is again from personal experience, and I've seen it is, there are people that have patience but have no faith, or people that have faith but have no patience. You need to have them going in sync. So you need both of these to be able to continue the journey despite what life throws at you.
Well, thank you very much for that. And maybe let's kind of go more into the fundraising side of things, and your advice to startups and to founders and just really anyone interested in entrepreneurship. So after a founder has raised from friends and family and has crossed that phase and is already getting traction, what would you say is the most important next step for them to keep that momentum going and to start looking at more perhaps institutional investors, VCs, maybe some family offices and the like?
Well, fundraising has always been a big part of my life, because after leaving banking in March 2008, this bit before the Lehman bankruptcy, I got into the tech space from a fundraising perspective. Raising money for startups, raising money from family offices, institutional investors, and so on. I think for me, fundraising is an art. It has to sound to investors just like any piece of symphony or music or something. And it's not about selling. Actually, it's really about talking to the right audience with the right tone. I think some of the difficulties and challenges when it comes to fundraising is probably surrounding yourself with the wrong people who are just transaction based, who can tell you, I know this guy, who can know this guy, who's gonna give you a check. But as you're progressing, fundraising should be taken really seriously, probably as serious as actually building the business. You need to know, this is how I'm gonna start my fundraise. These are the type of investors I'm gonna go after at the early stage that you mentioned. These are the investors I'm gonna leave until the end, because at the end of the day, you have one shot with all these investors. And if you meet the right investor in the wrong timing, you miss that opportunity. So even if he's the right investor, but he's for later on. So knowing all these things while you're doing the fundraise, it's very, very important. This is why I really look at it as an art. Like you have to dissect it and have a very clear vision. This actually starts really from the first institutional round that you do, after you do family and friends. And as you grow your company and start thinking about an IPO, for instance, you need to do the same thing you did at that early stage, that first institutional fund round. You have to do it before, at the growth stage, before the pre-IPO. there is another thing. So for me, it's more of something that you need to think through, the same way you think about execution of your idea of whatever you're working on.
Well, you rightly pointed out that fundraising is an art, and I fully agree with you on that. What would you say are the most important elements of that fundraising journey? Is it the person's character? Is it their track record? Is it perhaps the region that they're in, or the quality of their team? What would you say is the most?
It's a combination of all above, but as a founder, as especially at the early stage, people put money into you, into your team, right? Because most of these ideas are not generating revenue; they're still waiting to be executed, right? So basically, call it like after you come up with the MVP, basically, you want to go and raise money. I think first is the founder and the management team. I think the founder is probably 60%, the management team will be 30%, because I'm not going to just be putting money in you only. I need to see a whole team that can be able to execute. That's number one. Number two is when you walk into an investor's office, you better know your end game, where you're going to go, and basically knowing the business model clearly. You need to be able to articulate it. You need to know where the low-hanging fruits are going to come from when you execute a strategy. What are the short-term goals? What are the long-term goals? And you really need to know your numbers. You really need to know your numbers. I think going in just with an idea is not enough. But what I saw, founders sometimes making the mistake of just rushing. Because as any founder, sometimes you don't have the right guidance, and this is where mentorship and guidance comes in very important at a very early stage, because you need someone to help you. You can find very good founders, very good, bright, young men or women who have an idea, but when it comes to fundraising, you need to be surrounded with the right people.
So you obviously, you really enjoy that coaching aspect, and you mentored a lot of founders and other investors. What would you say, when you look at a pitch or an investor's pitch or a founder's pitch, what would you say is a sign or a subtle hint that when you look at it, you're like, wow, this guy really gets it. This guy is worth betting on? Because in the end, it's a bet, right? You're taking a gamble.
Not necessarily. I think there are a few things that sometimes you see a person and you can tell this is someone I want to work with or not. I think personally is about, and this is my rule now after all these years, is if I cannot align with you in certain life values, then I'm not going to do anything with you. It doesn't matter how bright your idea is, doesn't matter how smart is your business plan, doesn't matter how great is your idea, because you will learn this, and as you go in life, is if you go into a partnership with the wrong people, even though you make money, which for me now is becoming more transaction based, it's that journey will have a lot of pain. So you have to choose. Do I want to work with someone who we can both win together and it's going to be a pleasant journey? And when I say pleasant journey, it doesn't mean we're going to be friends and joyful all the time. We're going to have to have arguments sometimes and so on. But for instance, can we have an argument and then the following day we can go back to the table and figure out a way how to work it out? Or is it like the type of person who gets on an argument and that's it? It could be the end. So when you go into a startup situation and you're going to invest your money, you help someone, you need to make sure that you can go through thin and thick with this person, right? You can go through ups and downs with this person.
What are some signs that are early to spot within that person? Is it patience again, or is it their temperance? Is it their family relationships?
It's values. I mean, it comes down to few things, which again, values. Values are like integrity, ethics,
And how do you measure that? Or how do you sense that?
Before I'm gonna go raise money for you, before I'm gonna put money in you, I'm gonna spend some time with you. We're gonna spend time in the most odd situations where I can see your reactions, right? With people outside I have to see you in a different, environment. And then, then you can tell. I mean, these are things that you sense, and this is where gut feeling comes in. Like, when you're young, sometimes you feel like you want to prove something, right?
Mm-hmm.
And this is where people mix perseverance and grit with actually stupidity. Sometimes it's good to walk away from deals. Sometimes it's good way to walk away from people. But the problem that we have when we're young, sometimes, even when we get older, but we never mature enough. What happened is, it's not about grit or perseverance. It's more about the person trying to make a point. You have to put them to different contexts, right? You have to take them to different meetings. You have to take them into different environments. And sometimes you need to test. Unfortunately, I don't like the word testing people, but if you're gonna, and this should be not just in business, this is even personal life. If you're gonna be making a commitment to somebody, you really have to test. And testing doesn't mean you need to be tricky, but these are things that sometimes you can pick up on if you spend more time with people.
Sure. And I guess as a follow-up question to that would be, from all the founders that you've worked with in startups and various different roles, what would you say is the number one issue that founders always have, but they don't realize that they have that issue until, it hits the fan or it blows up or something really goes wrong?
That's a very good question. It's a lack of focus.
Lack of focus.
If we talk about fundraising in particular, I mean, there's many other things that we can discuss where sometimes they fall short. But when it comes to fundraising, it's really the lack of patience. And they say, okay, I'm just gonna spread my net as wide as I can because I need the money. But I think that's where the focus has to be, because for me, today, fundraising, venture capital is very, very different than 10, 15 years ago.
How is it different? Sorry to interrupt you there, but I think that's a very important point you bring up.
How is it different is 10, 15 years ago, liquidity was at 0%. Right? When the Fed had the rate at 0%, which means people got access to capital, and capital was literally free. So the risk, people had more risk appetite for things, and actually people really just it was more of a gambling, especially at early stage VC.
Mm-hmm.
And because I started this a while ago, I mean, this is around talking 13, 14 years ago. Back then actually was people had accessed no information, no financials, and still made investments. And this is what I called back then the right to brag versus the right for information, because back then people just used investing in startups as an opportunity when there are dinners and gatherings. They can say, oh, I invested in such and such company and so on. It was like more of a bragging rights. And VCs were very different back then too, because again, there was access of liquidity in the space.
So it was easier for both startups to get capital and also VCs to get capital from their LPs.
Exactly. So that's why now, after what we've seen, and also because of the liquidity crunch, especially in the VC space, the whole venture capital space is going to be changing now. The whole relationship between GPs and LPs, like general partners and limited partners, as an investor, will have to change, because we've seen a good 7 to 10 years where most VCs actually just lived off the management fee, right? But they never had any exit. And when they have the exit, usually it flops after the lockup. So I think investors now are starting to think, look, I don't think I want to be in such structures anymore. And this is why we're seeing the change in terms of how the LPs are putting their money into VCs. Mm-hmm. And how the VCs now are trying to move to a new cycle, which is they move into private equity, which is a big mistake, because being a venture capitalist has nothing to do with being private equity business. It's two different things, two different mindsets, and so on. But what we're gonna see coming up in this space is venture builders, which is VCs that are very specialized in certain industries, certain sectors, mm-hmm. that will put money and be more than just a passive investors. And that's the problem with VCs in the past. From a founder perspective, you also need to think similarly where, look, I'm gonna try to get money from someone that's gonna add value for me. Do not take money from someone who's just gonna sign you a check, right? And not add value in the long run. These investors become more of a headache in the future. You want to get money from strategic investors, for instance, I don't know, your business in the e-commerce or your business in a certain sector. You go to a family office that pretty much can add value from there, like whether from a real estate perspective, whether from supply chains perspective, where each dollar they give you becomes $5. It's stressful because as a startup, whatever dollars you're gonna take, you're gonna burn them, you're gonna use them. And so this is where I say, like, you have to be very careful about how you approach your fundraising. You can't just go spread your net very wide like everybody does, meet everybody. Because remember, once you meet that person, if you meet me today, and the thing is, some of this information is public. You know, each VC firm or each investor, they have a stage where they invest, whether it's early VC, whether it's late stage VC, whether it's growth. You cannot be early stage startup and then you're gonna go to growth investor. They're gonna tell you it's too early, come back to me later. But you blew up your chance there already. So, and what happening when you
goes
call them
back
again,
to your point about timing being everything.
You need to know exactly what you need, and you need to know exactly what you want. And sometimes what you want is not what you need, right? So go with the need, forget about what you want.
Oh, that's very interesting points you brought up, and I'm trying to kind of unpack them and ask some follow-up questions, one of which is on the venture builders. So this is a growing trend that I see as well. Perhaps would you like to explain more on the model of venture builders, or I don't know, sometimes they might be called venture studios, for example, and how they could overlap with VCs, with accelerators, with incubators, and where does this venture builder lie exactly in the ecosystem?
Venture builders are very different from incubators or studios. Venture builders usually are individuals, people that had track record building businesses, exiting businesses, and they usually will come from the same sector that you startup would be in. These are people that are really gonna roll up their sleeves. They're gonna put money, and they're gonna take a board seat, and they're gonna really help you grow that company. So they will have a very active role, which is what people do on the private equity side. This is why I told you a lot of the VC firms cannot do PE business, but because they're desperate now, they move into the PE side.
That was my follow-up question, which I think would also be very interesting to get into, is the difference that you see in the skill set of VC investors versus PE investors, because there's always people who go from VC to PE or PE to VC, or even, you know, the main feeder of both is obviously investment banks. So, you know, some people want to go into VC, some into PE. So what would you say is the difference in skill set, and what would you recommend, for example, from your experience having done both at some point in your life?
I think I see more the transition going from PE to VC versus the other way around. So if someone transitions from PE to VC, probably that VC firm, maybe I would, as a startup founder, I probably would want to work with. Because when you come in from a PC, from a private equity side, and especially if you're doing buyouts, right, or carve-outs and so on, you need some domain expertise. You need some sector expertise. Because sometimes as a PE firm or like a general partner PE firm, you take an operating role. You operate the business. You restructure it. You reshape it. You grow it, and then you exit it. With early stage VC guys or venture capital firms, a lot of them they put money, and they usually have an agnostic, basically, approach, where they like the business, they like the founder, they put money, but how much are they going to help you in the future? And sometimes they become a bottleneck, because sometimes you want to grow your business. You may want to adapt and make a turn. But having them in your cap table, because they came early on, they can become a bottleneck. They put a lot of pressure on you. They will put a lot of pressure for you to exit. They will put a lot of pressure, especially for early exits. Because a life of a VC fund is 5 years committed plus 2 years extension. So if your business cannot exit within 7 years, you're in big trouble with the VC firms. That's why, personally, I'll be very careful taking money from VCs.
Have you seen some of those types of disasters happening where, for example, the founding team, the startup didn't quite align with the expectations of the VC, and despite it being a very good startup, it just went downhill?
Okay, let me give you a very just quick rule about venture capitalists. The general partner, the fund manager of the VC, usually gets money from his LPs, from investors. They usually get money from institutional investors, they get money from family offices, depend on who they go to, and are they on their fund 1, 2, 3, because the more track record they have, the more money they can attract. However, each VC fund will have a maturity in the bylaws of the fund. So usually it's 5 years, 7 years. They usually come have extensions. So usually in that fund that they raise money, which is usually a blind pool, which investors now don't like this concept anymore, where you just give money, you don't know where the money is going. They will allocate this money across X amount of startups, right? With the hope that they'll hit a blockbuster, right? That's
which
usually
is the tail.
Yes. Unfortunately, what happens sometimes is you may have few exits, but you're always going to end up with maybe a few portfolio companies that will stay in the fund. But when the fund gets to its maturity, they need to distribute the capital back, right? So what are the options for them? Is either to sell the fund on a secondary, which they're going to have to take a massive discount. Usually selling a fund, and I'm not talking about single name secondaries, right? I'm talking about a fund secondary. They need to take a 30, 40% hit from the mark to markup that they have. So that's one way to exit. The other way is they're gonna get stuck with they're gonna pressure these companies to just sell them on an individual basis, right? To exit them, not through IPO, but through a sale. So if you happen to be a founder of one of these startups, they can push you to sell at any valuation they want, depending on what kind of terms you sign up with them. So if you are a founder today and you don't think you can grow your company and exit it within 7 years, then stay away from VCs.
And do what?
There are family offices, there are other options you can do. Or pick a VC that's gonna be right for you. I mean, again, I know this sounds like more like, okay, Moncef, like, you're not in our spot. Like, I've been a startup founder myself, and I raised money for myself and so on. It just, don't get too desperate where you make a mistake today where you think is the right decision. That's gonna cost you so much pain in the future. Because as a startup founder, you deal with a lot of pain. You deal with a lot of stress. You'll have no life. And the price that you do pay when you start a founder sometimes comes down to the family, because you will never spend time with them. So you have to make it worth, right? All these sacrifices that you make have to be worth something in the future. And if you don't have visibility in terms of where you want to go, just don't do it. Save yourself the pain, right? I know I sound a little bit harsh, but look, I failed probably 80% of the stuff that I've done. But again, some of the mistakes I've done could have been avoidable. But again, some of us only learn from mistakes. You can read a book, you can hear a story. People are probably listening today here, and they may not want to learn anything. They will look, I want to give it a shot myself. And that's where it comes back to the perseverance and the grit. Do not mix them with ego and trying to prove someone wrong, because you're always going to be paying the price. That has nothing to do with I'm not giving up. That's more about I'm going to feed my own ego to prove someone is wrong. That's the wrong approach to take.
One more thing I'd want to go back to is when you suggested that perhaps founders could also look at raising from family offices. Family offices are generally much more reserved, much more closed off perhaps or difficult to reach than VCs. And I've actually written about this in one of my prior blog posts on how founders can approach family offices in a more efficient way. So what advice would you give to founders that are approaching family offices or perhaps some high net worth individuals who would want to invest in their startup, especially because those people or those family offices are generally faced with a bombardment of cold pitches from various founders, from various brokers, intermediaries, etc. So what's your take on that?
We go back to the same point we discussed earlier. Is like, if I'm gonna approach this family office, why am I approaching them? Mm-hmm. Am I approaching them just to get a meeting,
for their values,
to get cash, or am I? There are two ways a family office will invest in you. Number one, most family offices today, they're all sophisticated enough where they have their own investment teams and so on. Well, there are two ways a family office is going to invest in your business as a founder. One is you are complementary to the existing ecosystem, okay, which means whatever you're doing fits in whatever they do exactly today. Or you are in a business where the family office can diversify. So when you go pitch them, say, hey, I know you in this business, I know in this, my company can fit in within your ecosystem and can actually, in fact, be used within your ecosystem. Or this idea will give you a way to diversify from what you do at core. Anything that falls away from these two, then they will not invest.
So given you've obviously worked in the US, in Asia, in Middle East, what would you say is the main difference or perhaps differences in the VC ecosystems between different parts of the world?
That's a very good question. I think given that I spent a lot of time doing work in the Valley and the US, I think, and actually being now in the Middle East for 12 months, there is actually a recipe for success. Yeah. And the recipe for success is getting the right ecosystem together. I think US has it, the Silicon Valley has it, right? I think China, particularly out of Asia, is probably the only place where it exists, right? I think the Middle East is probably getting there. I have not seen it yet. And what I mean about the ecosystem is gonna come back to fundraising. Do you understand? This is, again, why fundraising is very important. So in the US, as a startup founder, as someone who came up with this disruptive idea, you can go into there is seed investor, there are angel investors available, there is seed investors available, there is early VC investors available, there is like mid VC stage, investors available, there is late stage, there is the growth, there is the pre-IPO, and there is the crossover investors, and there is the IPO, right?
There's the lawyers, there's the advisors, there's everyone.
There is money for every stage of your startup. Mm-hmm. The difficulty for an ecosystem to thrive and to be successful is when you have gaps in the fundraising ecosystem. So what does it mean? It means that you did the friends and family round, mm-hmm. and then you have no one to do the pre-A round. Okay. Usually, who fills in these gaps? It's most likely family offices. Okay. And when there is not enough family offices that are willing to take the risk and contribute to their local economy and so on, right? Then the ecosystem is broken. What does it mean? Again, it means that this is perfect in the US today. Okay? In China, that's why we've seen many startups in China, and that's another mistake that people don't understand is not everything in China is a copy of the US. I mean, I've seen many models in China that can be copied in the US or in the Western world. But in China also what we see is there is everything from government funding to seed, there is labs, there is incubators, but there is enough families that can fill this gap. That's why we've seen a lot of startups coming out of China. That's not just one, also talent. Again, the mistake that people a lot do is they say, I met a lot of founders in China. These founders, they all went to Ivy schools in the US or in the UK. They all worked for big bulge bracket European and US firms, banks, investment banks. They all worked in big private equity fund before they transitioned to a startup. So pretty much they have the same caliber as anybody else in the US, right? Because the US is the most successful model, right? So the reason why we see a lot of startup coming up is, caliber of people is the same. The ecosystem is relatively the same. And that's why we were able to see a lot of startups and successful actually IPOs in China, where people made a lot of money, whether from the founders to the VC firms to the investors and for everyone in the ecosystem. We don't see this in many other places and regions in the world, right? I think in the Middle East also there is the issue of the market. So I think places like UAE, I think to succeed, you need to come in as a founder with the mindset of it's not just GCC. You need to talk about Middle East and Africa. You need to have a market, right? You need to have a growth story. Otherwise, it's too small. So coming back to the ecosystem, US is definitely the most advanced. I think China, and I'm talking China particularly, I'm not going to talk about Singapore. I mean, everybody else is trying. Another mistake that I see governments doing sometimes is the government steps in, like the case of Singapore, where the government set up, probably Singapore has the most sophisticated sovereign fund setup that I've probably seen anywhere in the world, like GIC in Temasek, where the government did everything they can to jumpstart the ecosystem. And when they jumpstarted for the whole Southeast Asia, not just for Singapore. However, because the government was involved so much, it didn't work at the end. But they did have the right kind of setup, I'd say, because they had the top sovereigns on the top. They set up subsidiaries of the fund, each one specialized in different sectors. It did work. It did work very well until things really went south because of valuations, because of many things. But in China, actually, after the US, I definitely would pick China. Also, one other thing that people need to keep in mind is, I don't know if you read the book of Peter Thiel, 0 to 1. Again, US is extremely advanced and very good at the 0 to 1, mentality of strategy, which is coming up with disruptive, innovative ideas. But when it comes to 1 to 100, I'll give it to Asia. Not just China, I'll give it to Asia, overall Asia. Application rate is a lot higher and a lot faster.
So I guess a natural follow-up question to that when we're talking about regions is when we look at the world from a more macro perspective, which regions or maybe even which industries would you say are the most exciting right now, or the hottest regions or countries to look out for and keep an eye on?
I'd say more of I would rephrase your question to more which sectors and which verticals. I think the whole ecosystem of startups and venture capital and all the stuff is changing now, really, and we will not see what we've seen 10, 15 years ago for sure. So for me, with sectors, obviously AI, right? It's going to be a big sector to look at. But then you cannot just look at it from an application or software perspective only, or from the language model only. I think the opportunity in the Middle East is massive, especially in the AI space. And here in the Middle East, if I were to focus on AI, it's great. I mean, we've seen the UAE investing an enormous amount of money with the UAE, Saudi Arabia, in data centers, in hardware, in software. But I would say, focus on where you have most data, right? Where you have an edge. And when I look at here in the Middle East, I think oil and gas, right? I mean, should be the main focus, and which you can learn from the data that you have today, developing the right applications. Then perhaps you can export it out of the Middle East. At the end of the day, I mean, the opportunity here in the Middle East is massive because, to drive AI adaptation and the growth of the AI sector in general, you need energy, you need power, and this place has a lot of it. And eventually, where we're gonna get to is, instead of exporting oil and gas and the raw material, you can actually export AI, right? So coming back to sectors, I mean, I'm quite bullish on AI, but again, I'm very conservative when it comes to where to put money yet. And this is where the venture building in AI is going to be very important. I mean, when I look at AI, and I'm going to just talk about software, I don't want to talk about everything else down, because infrastructure and down to copper and land and walls and energy is as important as the software, right? It's a whole ecosystem that dances together, right? I'd say specialization. If you're gonna invest in AI, pick a sector, look at it from a very specialized manner. Pick maybe perhaps companies that take in more of an R&D engineer mentality than specializing just in one thing. Because at the end of the day, in 3 to 5 years time, this whole AI sector is gonna be super, super customized. And it's gonna be customized to the user, and the user is the one who has the data. So what works for you may not work for him, but there'll be some similarities to an extent. And this is where I believe that the most successful AI companies are gonna be companies that have a bunch of bright engineers that will be able to adapt to any sector or industry, because it's gonna be very specialized.
So Moncef, what's one piece of advice that you wish someone gave you earlier in your career that you'd like to pass on to the viewers?
Walk away more than hold on to things. Put it this way, yeah. I wish someone told me this, yeah. Walk away. Walking away sometimes is the best thing you can do.
And do you have any specific framework on how to quickly judge whether you should walk away or stay?
I tell you, you feel it. I think that's the problem with us all. As you're young and everything, you always try very hard to not give up. But your gut feeling tells you give up, right? So you go against yourself. So I'd say the biggest advice I hope someone tell me in the past is walk away when you don't have the right feelings, right? You give it your best shot, but don't fight it too much, right? Walk away. You'll save yourself time, pain, everything. And this is something that I apply not just in business now, in personal relationships too. Sometimes you're not gonna get along with the guy, right? It's not gonna be, just walk away. No need to prove yourself, no need to sit down and tell him, I've done this for you and you've done this for me. You just walk away. Save yourself a lot of pain and time.
Thank you very much, Moncef.
That
was a sincere pleasure, and we wish you the best of luck with all your new ventures and your entrepreneurial journey. So thank you very much.
Thank you for having me. Thank you.